All right, my friends. So I welcome you again to this lecture. This is Yasir Yamin, and I'll be taking you through IFRS 15's advanced area, which is particularly relevant to the SBR paper. So in our earlier sessions, in our basic IFRS 15 sessions, we had already covered the crux of IFRS 15. We knew that there is basically a five-step approach towards revenue recognition. We identify our contract with customer, we identify separate performance obligations in a contract, we get to know how they will be satisfied, we determine the transaction price, allocate the transaction price, and then eventually recognize our revenue as and when the performance obligation has been satisfied. Now, having covered all of this, now is the time to uncover, or basically to cover, those areas that are basically, I would say, advanced areas of IFRS 15, and these are very much specific to SBR paper, and it will surely help you if you go through them. So we are talking about step number one, and this is all continuation of our basic lecture, and that is why I've already specified the continued part here in the slides. Now, one area that we also need to cover in step number one, during step number one, that was identifying a contract with customer. There is one area which is known as combination of contracts. So my friends, what do we mean by combination of contracts? A combination of contract is a scenario in which an entity enters into two or more contracts. I'll repeat it again. Combination of contracts is a scenario in which one entity, let's say it is ABC company, and it enters into two or maybe more contracts with the same customer. All right. So if an entity enters into a contract with the same customer near the same time, if a company enters into a contract with the customer, multiple contracts with the customer at that time or near to that time. What do you mean by near to that time? Industry wise market practices are different. But a general phenomenon is, for example, if a company enters into a contract with the same customer within 3 months, at that point in time or within 3 months, then this clause is applicable. Remember, this 3 month benchmark is not an IFRS specific benchmark. It is basically, it varies from industry to industry. As a given benchmark, the industry I am aware of, 3 month benchmark is used. So if one company enters into a contract with the same customer near to or at the same time, then the contracts may be combined. Then the contracts may be combined to be treated as one single contract. One entity may enter into multiple contracts with the customer at or near the same time, and all those contracts may be treated as one single contract, but there are conditions. If, so I'll repeat it again, an entity shall combine two or more contracts entered at or near the same time with the same customer if, remember, with the same customer or at or near the same time. If, now if there are three conditions, number one, number two, and number three, but if you look at, there is or between them. Or between them means if any one of the condition has been satisfied, combination of contracts would be applicable if even any one of the condition has been satisfied. So what is the first condition or an example? Contracts are negotiated with the single commercial objective. If a company enters into at or near the same time with the same customer into multiple contracts, and those contracts are negotiated with a single commercial objective, then those contracts may be combined to form a one single contract. Now in legal terms, those may be different contracts. But in IFRS 15, they will be treated as one single contract if they have a single commercial objective. Now, I'll give you one example of this. For example, ABC company signs a contract with customer, or rather signs two contract with customers. One contract is for licenses of software for their Karachi branch, and there is another separate contract that has been signed near to or at the same time. Let's say it was signed 2 months after, but it is also of licenses of same software but for the Lahore branch. So you are a company which actually sells licenses of software of a very customized software, and one customer comes to you and signs one contract 2 months back for their Karachi premises, and then signs another contract for Lahore premises. And the objective of these two softwares are as such that they will achieve one single company level commercial objective. For example, this software will help them to fulfill their customers need, the third customer's need. All right. So this is basically, there are two contracts, they are signed with a single commercial objective, and they will ultimately satisfy one single commercial objective. Then these two contracts shall be combined to be treated as one single contract. So all the 5 steps would be followed on one single contract. This is first example. Now moving on to the second condition. This says that if there is interdependence between prices of both contracts, so the company enters into two different contracts, but there is interdependence between prices of both contracts, then those both contracts, legally separate contracts, should be combined together under the clause of combination of contracts. Now, how can there be interdependence between prices? It can be a scenario in which the B contracts payment terms are linked to the satisfaction of contract A. So if the other contract, which is subsequently signed, maybe 15 days after, 2 months after, or 3 months after, and it is actually linked with the completion of the first contract, its payment terms are linked with the first contract, then actually in substance terms, these both contracts should be combined together and treated under combination of contracts. Now it is very routine. For example, your customer signs a contract with you for delivery of goods, maybe a machine. They want you to deliver a machine to them, and then signs a contract for maintenance services after 2 months. And it says that the payment for maintenance services will only be made after the complete delivery of goods. Then only maintenance services will be paid for. So that means there is basically, the interdependence between prices and payments of both contracts. Therefore, both contracts should be combined together. One example is this. Now, the third example that we are going to discuss of, the goods or services promised in the contracts are a single performance obligation. You feel that there are two separate contracts, but they ultimately lead to one single performance obligation. In that case also, you can combine both contracts. And I'll give you one practical example that I've seen in my life. I'll just share it with you guys as well. So I'll just clear the markings just to get enough space, and I'll give you a practical example of this. So for example, S company is a company, it is the seller company, and it signs a contract with the government. For example, say government of Pakistan. S company signs a contract with government of Pakistan, where they need to bring the whole electric connectivity, the whole infrastructure power connectivity to the control center in Islamabad. I'll repeat the scenario. S company is the seller company, and they sign a contract with government of Pakistan. As per the contract, their obligation is that all the power data, You see, power is generated across, for example, Pakistan. It is generated in Karachi, it is generated in Lahore, it is generated in Sakkar. There are power plants which are, spread across the country. So the requirement of government of Pakistan is that you gather all the power data, the voltages, the trippings and everything, and you bring it to the control center, which is in Islamabad. Now, S company wanted to sign a contract with government of Pakistan, but they actually signed, the both parties signed two contracts, contract 1 and contract 2. Now you would be thinking why government of Pakistan would be signing two different contracts, because one contract, according to one contract, the data was to be flown from Sindh, and the according to the other contract, the data was to be flown from Punjab power plants and ultimately to the control center in Islamabad. So the power plants in Sindh, their data, and the power plants in Punjab, their data had ultimately to be flown to the control center, which may be built in Islamabad, for example. Islamabad is the capital territory. So they had to sign two different contracts just because of provincial autonomy. So provincial autonomy, which is prevalent in Pakistan, each province has a right to their own province jurisdictions, and that is why Sindh authorities were different and Punjab authorities were different, and that is why they signed particularly two contracts. But don't you think, even though legally they had to sign two different contracts, but ultimately the contract party was the same, government of Pakistan, and there was one single performance obligation to gather all that data and bring it to Islamabad. It had to be gone through Sindh and gone through Punjab and then ultimately reach Islamabad. So basically, it is a single performance obligation S company is entitled to. Legally they had to sign two different contracts because of provincial autonomy and because of legalities. This often happens everywhere in the world, but substantially this is one single contract, and therefore IFRS 15 says that you combine these both contracts into accounting. Legally there are two different contracts, but when you're accounting for these contracts, just combine those contracts and treat it as a combination of contract and treat it as a one single contract. Understood? And I'll like to explain you this further by giving you an example. This is a very good example, and I would want your interest in this so that we can just implement whatever we studied for combination of contracts. This is a very good scenario that can easily be tested in your SBRs, so much to say theoretical exam. All right. So in this example, we basically have two scenarios. There is sale of software and there is sale of warranty. There is a, for example, warranty action. So your examiner says on 1st January 2015, Smart Company won a contract to deliver fully customized engineering software. Remember, these are customized engineering softwares for 10 users to Country Electric. So there is one company whose name is Smart Company, and it has to provide for 10 users fully customized softwares. All right. All right. So the transaction price agreed was $12 million, including a $2 million one-off customization fees. So that means $2 million were charged as a customization fees. That means these licenses of software were very much specific to the customer only. The software was to be delivered within 4 months of the contract date. So if we see, on 1st January, the contract was signed. The delivery had to be made within 4 months. That makes it 30th April approximately. The contract entailed that we had to deliver 10 user licenses and also a one of $2 million customization fees was also charged. All right. Now the examiner says on 1st February 2015, that means they are talking about after 1 month. On 1st February 2015, Country Electric ordered licenses for additional 10 users for $10 million. Country Electric made a separate contract for another 10 million, so another 10 users for $10 million. All licenses were to be delivered by 30th April 2015, means to say the delivery period remains the same. Another contract is done for another 10 user licenses. Now the question is, do we combine this sort of contract, yes or no? We'll just carry out an assessment. Is the contract signed with the same customer at or near the same time? Yes. The contract is signed with same customer, Country Electric, and near to same time, just after 1 month. These can be combined together if any one of the condition has been met. Number one, do they offer single commercial objective? Most likely yes, but we are not very sure of it, but most likely yes, because they are the same customized licenses being offered. So obviously they'll be fulfilling the same purpose, right? The other point was, is there any interdependent between prices? Do you think there is an interdependence between prices? I would definitely say yes, there is an interdependence between prices. You see, the first contract was done for $12 million with a $2 million customization fees. So the normal price for these 10 user licenses was 10 million. $2 million was a one-off customization fees. And if you see, it was not charged the next time. The next time, the additional 10 user licenses were also sold for $10 million, not $12 million. The one-off customization fees was not charged. So definitely if your customer had come to you and told you that we want additional licenses, you won't be charging any extra money for them. That means it is the same contract which has been extended from 10 users to 20 users. Although legally they are two separate contracts, but substance wise, this is a single contract with additional 10 users. So should we combine these two contracts? Is there any interdependence between prices? I would say yes. And if we further go on and see, do they offer a single performance obligation? Yes. Both the licenses have to be delivered on the same date. So there is a single performance obligation because they have to be delivered at the same time to the same customer with the same conditions. So there is a single performance obligation, definitely. So I would say combine these both contracts. All right. Now we'll see towards another area. There is a warranty clause. Additionally, you see, additionally means that this area is not relevant to the area that we discussed right now. This is a separate contract that we are talking about. Additionally, Smart Company agreed to replace two equipments under warranty. The equipment had to be supplied within 1 year warranty at the start of this year. The cost of replacement is expected to be $5 million. Normal markup is 15%. Now, technically, this is not a revenue transaction. Why? Because although delivery has to be made, for two equipments, but this is a warranty contract with no additional consideration involved. So this is basically not a revenue transaction, but a warranty clause invocation by the customer only. Make sense? So this is an example of combination of contracts. I hope you understood it. Now this can easily come into your, much more theoretical exam of SBR. So you must be really prepared for it. Okay, all right. So we'll just move on to another area, which is under step number 1 still. And this can also come into your SBR paper. And relatively, this is, slightly more numerical and more technical, I would say. So beware of this scenario. The area that I'm going to talk about is basically modification of contracts, which is often known as a change order or a variation order. So the topic we are studying is basically under step number 1, and the topic is about modification of contracts. Sir, what do we mean by modification of contracts? You see, a modification of a contract is when there is a change in the scope or price or even both of a contract. If there is a prevailing given contract and subsequently the price of the contract is changed, or the scope of the contract is changed, or in often cases both are changed, this is basically a modification of contract. For example, there was one contract named A. You had to deliver one type of AB product to the customer. Later on it was modified that you have to deliver ABC product to the customer. This is a modification of contract, change in scope. And logically, if there is a change in scope, you have to deliver ABC, not AB. There might be a change in price as well. So this is known as a modification of contract. Now the question in IFRS 15 is what to do when there is a change in contract, there is a variation in contract, there is a modification in contract. How we account for such type of contracts? So my friends, there are basically two approaches in a modification scenario. How do you account for modification of contracts? There can be either of two solutions. Either the modified portion of the contract will be treated as a new contract. Number one, either the modification of contract will bring about a new contract. For example, you had a contract with your customer whose name is A. You had to deliver AB, and now your customer, by looking at your commitment, your quality and everything, now a customer also wants you to deliver XYZ. Now, for example, this XYZ has no relation to AB. AB is something else. You have to deliver that AB as well. And now also customer sends you a variation that please also deliver XYZ, which is a altogether separate product. It has no relation to AB. So my friends, in that case, this is a separate thing. This is a separate thing. This is a separate performance obligation. This is a separate performance obligation. It's better to treat these two items as a separate contract in totality. All right. So one accounting treatment could be that you treat the modification as a new contract in itself. In that case, there will be two contracts rather than one contract. It is the vice versa of combination of contracts. Under combination of contracts, we used to combine two contracts into one. Under the first accounting treatment, in case of modification of contracts, there would be a single contract which has been modified. But if you treat them as a new contract, there will in accounting at least, there will be two different accounting contracts to be dealt with. So it is basically bifurcation of a single contract, opposite of what combination of contracts were, right? The other treatment, which is the more technical treatment, I would say, is basically modification of existing contracts. One is that you make the modification, you treat the modification as a new contract. In that case, there are two separate contracts. Separately, you have to follow those 5 steps of IFRS 15. But in case new contract is not established, but the same one which you are carrying since before is modified, then there is some technicality. How would you know that either you need to go with step number 1 or step number 2? Option number 1 or option number 2? How would you know that? Now there is some indications. IFRS 15 says that if the modification results in distinct goods or services, which is represented by standalone price. What do you mean by that? If the contract is modified and the customer asks for something which is unique in nature, it has no relation to the previous product, and it is also represented by the fair value, the standalone price, then technically, although only one contract, one legal contract is prevalent, but this is something exactly, absolutely different, and the other thing is absolutely different. In that case, you treat them as a separate contract, because this is a distinct good or service. This is a distinct good or service, and there is no interdependence between prices. You segregate these into two accounting contracts. Separate five-step approach will be followed on each of the contract, right? But if the modification results in but if the modification results in no distinct goods or services being offered, with no modification, with no standalone modification in price, then you treat modification within the existing contract. For example, in my example number one, my customer said, I don't want AB, but I want the more premium version of the AB, which is ABC. Now it is the same thing but a premium version. Obviously there will be some price combination, compensation, but it is the same type of thing that is being offered. It is not a distinct good or service. It is the same thing with more premium quality. So you do not treat it as a separate contract, rather you treat your existing contract with modification. And how that works is that you treat it as if the existing contract has been terminated and a new contract is formed. You would say, you will assume that if the existing contract has been terminated, the AB contract is gone and a new contract of ABC is formed. You will treat is as if since day one it was ABC product being offered. Okay, so modification of contracts requires some certain actions that we are going to discuss. All right. In case of two separate contracts, no worries, no effect on current contract. You will apply five-step model on the new contract as it has to be done. But if the existing contract is modified, so to say, there is no distinct good or service being offered, there is no standalone price scenario, and the existing contract is modified, then you have to follow a certain approach which is known as cumulative catch-up basis. The process is known as cumulative catch-up basis. And I'll let you know what cumulative catch-up basis actually means. Cumulative catch-up basis actually means that you will adjust your revenue to reflect current progress. If the contract has been modified and it does not result into a new contract, then you will modify your existing contract as if the old version has been deleted and a new contract has been formed. And as a result of this modification, your overall accounting will change. You will adjust your revenue based on the current progress, which is known as cumulative catch-up basis accounting. All right. Now you must be pretty much worried, sir, how do we actually account for cumulative catch-up basis? How do we do that? For everything, there is an example. Let's see a good example, and through this, I'll help you in understanding how cumulative catch-up basis actually works. And I'll try my level best to make it as easy as possible for you guys. So just listen. This is an illustrative example. We have to work this out. We have to illustrate what happens. So there is XYZ Limited, which completes commercial construction projects. XYZ Limited is a company which completes construction projects. XYZ Limited has entered into a contract with a customer to build a new 10-story office building expected to take 2.5 years to complete. I'll repeat it again. XYZ company has entered into a contract in which they have to build a 10-story building for a customer. 10-story building for a customer, and it will take 2.5 years to build. Now you must have guessed it right. This is a long-term contract, most likely a point over time contract. You must have guessed it right. All right. So we have to follow those 4-step approach. All right. We'll identify total profit or loss, stage of completion, and then P&L extract and SOFP extract, whatever we used to do. All right. The examiner says this contract is for a fixed fee of rupees 25 million and has determined to be a single performance obligation. All right. Total contract cost is expected to be rupees 20 million. So if we follow our first step for point over time contracts, it was to identify total profit or loss. All right. So the total contract price, what is the total contract price? It is 25 million. What is the total contract cost? It is 20 million. So is the contract profitable? Yes, it has a total profit of 5 million. You get this point? So the contract is basically a profit making contract. Done. It says that at the end of the year one, when XYZ Limited determines that it has satisfied 45% of its performance obligation. So if you remember, our second step was to determine stage of completion, and in this question, it has been given as 45%. Just to have a fair bit of idea, just to, recall what we've studied. How would the examiner have calculated this 45%? Just think about it. The default method for stage of completion calculation was that you would take cost incurred to date in your numerator and divide it by total contract cost. And therefore you would have determined 45% of stage of completion. Just for the sake of it, even if we work it out. So 45% is your stage of completion given by the examiner. Your total cost of the contract is basically 20 million. And if we put X here, so just redetermine what would have been the actual cost. Just a fair idea. It would have been 9 million, right? So your examiner is basically saying $9 million would have been the actual cost out of the total contract price of 20 million, and thereby I have already calculated 45% of stage of completion. Our examiner has helped us in that regard. Understood? Now the third step was to prepare a P&L extract. How would you prepare a P&L extract? You take sales revenue, you take cost, and there you have your profit. For sales, we have a stage of completion of 45%. So our total contract price is 25 million. 45% we have satisfied our performance obligations. So 45% should be the revenue. If we are recognizing 45% of the revenue, then 45% of the cost should also be recognized, which is matching concept. So 20 million into 40%. So what is the, we would say 25 into 45%. This is 11.25 million. And the cost would have been 40% of 20. So this would have been, 45% of 20, that would have been 9 million. So the profit would have been, I would say, 2.25 million. Just let me erase this, please. So the profit would have been 2.25 million. All right. This is how it would have been done. And once the company had determined that revenue should be 11.25, what accounting entry would have they prepared? They would have credited their revenue by 11.25, and if not actually billed to the customer, it would be a contract asset debit. 11.25 million. If the billing has been done to the customer, there is nothing mentioned in this example, so we'll just assume that billing has not yet been performed. Otherwise, if the billing had been performed, it would be receivable debit and revenue credit. If the billing has not yet been done, it would be a contract asset, the unbilled amount, and then the revenue would have been credited. So we understand what had been done till now. Make sense? Now we have read this question. We have read this question till here. Till here, nothing is unique. But now the unique part comes in. Just see. It says soon after the year end. Soon after the year end means 1st January next year, for simplicity. Soon after the year end, customer requests a change order because it wants to be compliant with the new environmental standard and therefore will need to change, among other specifications, all the windows. Now your customer is basically not ordering a distinct good or service. You had to prepare a 10 story building, and now the customer is just saying, just change the windows please, because I want to be more environmentally friendly. I want to, more energy conversant, and therefore I just want you to change the windows. Now that is not distinct good or services or a standalone price scenario, therefore this will be treated as a simple modification of contract. That obviously, if the customer is ordering new type of windows, they would come at a cost to the customer. Your examiner says the total cost to the customer for ensuring the building is compliant with this new standard will be an additional rupees 5 million. The customer would have to pay additional rupees 5 million, and the cost to XYZ Limited would be 4.5 million rupees. That is the additional cost to the company, to us, XYZ Limited, would be 4.5 million. So if you see the contract, I'll just change the color of my pen for the sake of clarity. So the contract has been modified. And if you think about it, after the modification of contract, what is the revised price? What is the revised price? It is basically 25 million rupees for the original contract, $5 million for the 5 million rupees for the variation. That means $30 million is 30 million rupees is the new value of the contract. I just very much conversion to dollars, I would say. And what is the revised cost of the contract? 20 million rupees was the earlier cost. Sorry. And 4.5 million rupees is the new cost. That means 24.5 million is the new value. So 30 million minus 24.5 million means the profit has been revised to 5.5 million of the contract value. Make sense? All right, done. Now, what is cumulative catch-up basis? You see, in such a scenario where distinct goods or services have not been offered as a result of modification and your customer modifies your existing contract, you have to apply cumulative catch-up basis. And by cumulative catch-up basis, we mean that you have to redetermine the stage of completion. Obviously, if you redetermine the stage of completion, it would be a redetermination of revenue and cost and profits as well. You have to redetermine the stage of completion based on the adjusted values of the contract. So if we recalculate stage of completion, our total contract cost is now 24.5 million. What is the actual cost incurred to date? It still says 9 million rupees because this is, soon after the year end, means no progress would have been done till now. So 9 divided by 24.5, which is the new contract cost. Earlier it was 20 million, now it is 24.5 million. It is around 37% rounded off. And how would it affect our P&L? Just look at it. How would it affect our P&L? If we prepare P&L extract here, revenues. So our contract price is now 30 million. Our contract cost is basically 24.5 million, but they would now be multiplied by 37%. So what is the revised revenue value? 30 million into 37%, this is 11.1. And the contract cost would be 24.5 into 37%, it would be 9.1, which means that a profit of $2 million worth should be recognized in P&L just. Now, if you see, you had already recognized revenue of 11.25 million. 11.25 million worth of revenue had already been recognized. And now, based on the revised contract values, you need to recognize a revenue of only 11.1 million. That means a revenue reversal, revenue reversal of 0.14 million is required due to cumulative catch-up basis. Cumulative catch-up basis. Due to cumulative catch-up basis, a 0.14 million reversal is required in revenue. And that means you would debit your revenue by 0.14 million, and either you can credit your contract asset, but rather you will be crediting refund liability. If the billing has been done to the customer, you will be crediting refund liability, or in other case, if the billing has not been done to the customer, you can still credit your contract asset. If the billing has been done, then the contract asset would have been converted into a receivable. In that case, you can only credit a refund liability. But if the billing is yet to be done to the customer, it would still be a contract asset. You can directly credit your current your contract asset as per the situation. So this process is basically known as cumulative catch-up basis. All in all, what did we understand through this process? Whenever there is a modification in contract and there is no separate contract being formed, you need to calculate your revised stage of completion and adjust your revenue according to the modification. I hope it is well understood by this scenario. All right, just think about it. Take 2 minutes and just think about it. Whatever we have done, just make yourself explain it to yourself. I always say that the most difficult point in your life is to teach yourself. If you can teach yourself, if you can justify yourself, you can justify it to anyone. So just take 5 minutes, 2 or 5 minutes, and then explain this scenario to yourself, and then I am very sure you won't forget it. By your exam, you won't forget it. Throughout your life, hopefully, inshallah, you won't forget it. All right, take your time. All right, so moving on, now let us get to step number 3, the continuation of step number 3. During our basic lectures, we studied that transaction price is basically the combination of two things. One is fixed consideration and one is variable consideration. And an entity was required to estimate if it can fulfill the obligations to catch up on variable consideration, yes or no. And we also studied that variable consideration could either be positive or negative, and the entity has to make an assessment. We studied that examples of variable considerations could be bonus, price escalations. Negative variable consideration could be credit, coupons, or penalties. All right, so now there is an extension towards the concept of determining transaction price, and here we are discussing financing components which are sometimes built in the transaction price. Yes, we are discussing significant financing components in the transaction price. Before I even start to explain you what is this all about, I would say just consider this fact. Nothing in this world is for free. So if you enter into a contract with your customer on some unreasonable credit terms or payment terms, definitely there would be an impact on the price. Definitely there would be an impact on the price. I'll give you an example. For example, you are ABC company and you go to your customer and tell them that, see, I have made this product. I can sell you this product for $5 million. All right. And your customer reverts to you and says that, okay, all right, I like your, for example, I like your shopping mall that you have constructed, or I like your product that you have made, but I'll pay you $5 million, but I'll pay you, for example, after 2 years. The payment terms should be that I'll pay you after 2 years. Now just think about it. Would you offer this good or this equipment or whatever your product is to the customer on the same terms? Your customer is saying that okay, I'm happy with your product, but I can only pay after 2 years. Would you sell your product for the same 5 million to your customer? Yes or no? You would say no, 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 no. Wait. If the payment terms are supposed to be like that you're going to pay it after 2 years, then we are happy to sell you this product, but rather we are going to offer you a price of $6 million, right? And just assume that your customers actually accepts this offer and says, okay, I'll buy this product for $6 million with a payment term of 2 years delayed payment. Do you really think that the good or service has been sold for $6 million? The answer is no. Actually, the transaction price that you are just seeing of $6 million contains a significant financing component of $1 million. IFRS 15 wants to recognize revenue based on the fair value of goods or services. Technically, if you look out for it, the real value of the good was $5 million. The transaction price was ultimately $6 million just because of the delayed payment terms. Otherwise, the real value of the good or service was $5 million. Don't you think that revenue should be recognized based on this 5 million and rest should be recognized as interest income? Because then the company would only be inflating its revenue just by adding good payment terms. It would be inflating its revenue, and that is not true. The real value of the good was $5 million. The additional $1 million that we got was just due to the financing arrangement that we entered into with the customer. Make sense? So, what have we learned here is that IFRS 15, the objective of IFRS 15 is to reflect the transaction price for revenue recognition, which depicts cash selling price. By cash selling price, it means it wants to depict revenue based on the fair value of good or service. If there is a significant financing component in the transaction price, included in the transaction price, then you need to segregate the interest component separately and recognize revenue based on the fair value of goods or services. Make sense? Now, if you have understood that we need to segregate the fair value of goods or service and the financing element separately in order to recognize revenue, how would this work? I'll take you to an examination kit question, which is known by Verge. It is an extract, a part of the total question, but yes, this is very relevant to what we are studying right now. So in this example, it says that Verge entered into a contract with a government body on 1st April X1. So it was 1st April X1 and you entered into a contract with your customer to undertake maintenance services on a new railway line. So what your contract is, you have to basically maintain the railway line of the country, for example. Now, generally, if you think that maintenance services are routinely paid for, right? For example, what could be the most likely scenario of a normal contract? You go to the government and you say, okay, we accept your contract to maintain railway lines, we will do that, but we will keep you billing on a monthly basis or maybe on a quarterly basis, and then you can release our money on a monthly or a quarterly basis. That should be the normal scenario. Understood? The examiner says the total revenue from the contract is 5 million. So the transaction price is 5 million, and it is a year period contract, which means it is a point over time contract. Generally long term contracts are point over time contracts. All right. The contract states that $1 million will be paid at the commencement of the contract as an advance, you can say. But the government authority will only settle the subsequent amounts owing when the contract is completed. Oh. Now, here is the true point. You enter into a contract on 1st April X1, which is for 3 years. So it will go to the first year should be 31st March X2, 31st March X3, and then 31st March X4. The government is saying we can only pay you $1 million right now. All right, this is an advance, a 20% advance. But the 80% payment, we will not pay you monthly so you can keep up with your expenses. We will not pay you quarterly so you can keep up with your expenses. We are not going to pay you even annually to keep up with your expenses. But rather, we are going to pay you after 3 years. The rest of the money, which is the 80% amount, $4 million, they are saying they will pay you after 3 years. Now, don't you think that this 4 million would have a significant financing component embedded in itself? Why would a company accept 3-year extended payment terms? Why would it go for 80% of money to be withheld for 3 years and then paid off? Why? It will only do that if it is paid more with interest. It will only do that if the transaction price is sufficient to also include the time value of money. Means this $4 million remaining would also be including the financing component. Make sense? Make sense? Now your examiner says the invoices sent by Verge to date, including 1 million above, were as follows. On the first year X2, you have $2.8 million dollars worth of invoice. This includes 1 million as well, and $1.2 million worth of invoice on year 3. So for example, to date, you have completed 2.8 million scope of the contract, and here another 1.2 million of the contract. The balance will be invoiced on 31st March X4. Verge has only accounted for the initial payment in the financial statements to 31st March X2, and no subsequent amounts are to be paid until 31st March X4. Now, firstly, what about the $1 million advance? This advance will be treated as a liability. You will do cash or bank debit $1 million, and advance income, a refund liability, will be credited by $1 million. All right. So this is one part of it. Now, examiner says the entity has not accounted for any of the subsequent bills it has submitted. Now that is wrong. You see, we don't do cash-based accounting under IFRS 15. If the performance had been satisfied, you should have recognized revenue. Your examiner is saying no subsequent amounts have been treated under financial statements because no cash is to be received for another 3 years. No, this is a point over time contract, and under point over time contracts, you can recognize your revenue up to the extent of your satisfaction of your performance obligation. You had to go about it. This had to be done. So the problem is, there are two problems. Number one, Verge has not recognized revenue. It should have recognized to the extent performance obligation. You can't write PO in your exam, okay? So write it full. So to the extent performance obligation has been satisfied, which is probably the amount billed. You see how much performance obligation would you have most likely satisfied, and under you see no stage of completions or nothing is given in this area in this question. So it would be most reasonable to assume that the amount of billing that you are doing to your customer would be the most reasonable estimate of your revenue amount. Mhm. Verge wishes to know how to account for revenue on the contract in the financial statements to date. How to account for this revenue in the financial statements to date. Market interest rates are currently at 6%. Market interest rates are currently at 6%. So, what should be the amount of revenue that should be recognized? I would say in year one. By the way, the problem number two was uh, what was the problem number two? Yeah, it contains a financing component. The transaction price includes financing component. This was problem number two. So in year one, how should Verge recognize revenue? You see, including 1 million, this $1 million does not have any financing component because it was paid on year zero. There is no problem. But for the rest of $1.8 million, this would definitely have a significant financing component. Therefore, the financing element, the value of time money should be segregated in order to recognize revenue. So I would say this $1.8 million should be discounted. Should be discounted. And how do you discount that? You use a discount factor which is 1 divided by 1 plus the market rate is given 0.06, so 1 divided by 1 plus 0.06, this is year 1, so we take a discount period of 1 period. So what you would you be doing is 1.8 million divided by 1.06 plus 1, this would equal to approximately 2.7 million, 2.7 million worth of revenue. So I would say that Verge should recognize 2.7 million of revenue as against satisfaction of performance obligation. The rest 0.1 million, I would say the rest 0.1 million may be treated as interest income. Understood? So the main point IFRS 15 is trying to make here is that whenever the entity recognizes its revenue, the financing component should not be made part of the revenue, because in that case, since the prices are inflated with the amount of interest, the revenue would also be inflated to include the amount of time value, the amount of interest income. Rather, the revenue should reflect the fair value of goods or services, and therefore, if any significant financing component exists in the contract, you would segregate that and recognize fair value of the goods or services as revenue. This should have been done. Make sense? Now, in your homes, you can do either two as well, just for the sake of it. All right. Uh, you can follow this. I hope it is pretty much understandable. All right. So I believe this is the, one of the finest areas of step number 3 that we have just discussed. However, there are two more, smaller areas of step number 3 that we need to cover in order to make sure that we are done and dusted, from the advanced areas of IFRS 15. It is very important to know the accounting standard in its entirety. You never know what small areas are tested in your exam, and the more you know, the better you will feel while going into your exam. All right. So my friends, one area that we are going to discuss: sir, what if there is a contract between two parties and your customer offers you non-cash consideration? For example, your customer says that I will buy your equipment in exchange of giving you a building. You can take my building, you can take my machinery, you can take my other asset, and I'll give you, and you give me your machinery. So it is basically a barter. Such considerations should be valued at fair value. So if you're getting a building, if you're giving a good, then just measure the transaction at fair value. That is the term that IFRS 15 would like you to say. One more area that we need to discuss as other areas of IFRS 15 within the step number 3 is if some consideration is payable to a customer. Oh, whoa, 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 whoa. Sir, we don't understand this. Sir, routinely, customer is a person, customer is someone who pays us. What if we have to pay to the customer? Sir, what is this scenario? For example, there is one ABC company, right? Whose largest customer is K Electric. Now, K Electric is a power utility in Pakistan which provides electricity to its customers. ABC company is selling a machinery to K Electric. So you're right. If we sell machinery to K Electric, we definitely have to receive money from K Electric. We have to receive money from K Electric. You are absolutely right. But you see, K Electric is a utility company. Mm-hmm. So there is a good possibility that we are also buying electricity from K Electric. So while we are the suppliers of K Electric, we have to deliver them a machinery. We can also be customers of K Electric as well. So there can be a scenario where consideration is actually payable to a customer. It is payable to a customer. So, sir, how to account for these transactions? IFRS 15 is pretty much clear about these transactions. If the consideration payable represents the standalone price received from the customer, then treat them as general purchases. For example, in my scenario, if you are getting electricity from K Electric on normal commercial conditions, then don't worry. Just treat it as a general purchase like you would be doing in all of the purchases. For example, I'll give you another example. You are a company that delivers very sophisticated lighting material. Now you are selling your lighting material to the airport nearby, but you also use that airport or that airline for your traveling purposes. Now your customer becomes your supplier as well. But if you're buying the ticket on normal fair value terms, then you just treat it as a general purchase. Don't mix up these two type of scenarios into one another. Just treat them as a simple general purchase and account for them as you usually did. Don't intermingle these two transactions. However, if the consideration payable to the customer is basically a reduction in transaction price, for example, K Electrics tells you, you sell me your machinery at a given price, and we give you a coupon or a credit on your electricity bills. You won't need to pay your electricity bills. You give us your machinery. Then it is a separate thing. Then that coupon or credit will be basically a negative variable consideration and will be deducted from your transaction price. So all in all, general purchases should be dealt with generally. And if there is a specific coupon or credit being provided to you by the customer as a part of the contract, then you reduce your transaction price or you adjust your transaction price accordingly. If it is not a general purchase, then you treat it within the same contract. You reduce or escalate your transaction price, whatever the scenario may be. Or if it is a general purchase, you treat it as a general purchase like any other person would be doing. Make sense? All right. Now, my friend, final areas of IFRS 15. The advanced area that we are just discussing of IFRS 15, these are the final areas. Just look at them. How to deal with any incremental cost of obtaining a contract. What can be cost of obtaining a contract? For example, you have to pay commissions to an agent. For example, in order to obtain a contract, you paid commission to an agent, or you bought some bonds, or you bought the tender. How to deal with cost of obtaining a contract? IFRS 15 says an entity shall recognize as an asset the incremental cost of obtaining a contract with customer if the entity expects to recover those costs. For example, you are paying commission to an agent of 2% of contract value. You paid 2% of contract value to an agent. Now, rather than recognizing that commission expense as an expense, normal entry would be commission expense 2% and cash credit 2%, right? But if it is such type of a contract in which you will be reimbursed the commission amount, if it is such type of a contract that your end customer says that if we finalize this contract with you, we will compensate you the agency cost. You see, your customer had put an agent in between. You had to pay 2% to that commission agent. And for example, your customer says that if we finalize the contract, and we will hopefully do that, we will reimburse you the 2% commission cost that you just paid. In that case, you can rather treating this as an expense, since this is a cost of obtaining the contract which is reimbursable. You expect to recover these costs, therefore you can treat it as an asset or maybe receivable. You treat it as a receivable 2% debit and cash 2% credit if it is recoverable. Make sense? So if there is a cost of obtaining the contract which is recoverable, you don't treat it as an expense, rather you treat it as an asset, as simple as it may be. What are the costs to fulfill a contract? Any cost which is directly attributable to the contract, any cost which assist in satisfaction of performance obligation, any costs which are expected to be recovered from the contract, these should be treated as cost of contract. What is IFRS 15 trying to say? You see, there are some types of cost which are known as non-progress relevant cost. Now just try to understand what I'm saying. You see, if you follow IFRS 15 and you are recognizing revenue on point over time basis, you calculate stage of completion. And this stage of completion is calculated as cost to date divided by total contract cost. Now IFRS 15 has a problem, an inherent problem. What? That if the company somehow creatively manages cost to date, if it increases cost to date, the stage of completion would increase. If the stage of completion increases, then the revenue would increase. Make sense? So IFRS 15 says that only those costs can be considered for the calculation of stage of completion which are progress relevant cost. If there is a cost which is non-progress relevant cost, for example, you just threw a contract signing party, or maybe a press release. Maybe you threw a contract signing party to all your customers, your employees, and so on and so forth. You cannot treat this type of cost as a progress relevant cost and calculate stage of completion, because neither it is directly attributable to the contract nor it will help you to satisfy your performance obligation, and after party does not help you to satisfy your performance obligation towards the customer, and the customer won't be paying your party expenses. So you cannot charge those type of cost under the stage of completion scenario and inflate your revenue. That is not possible. All right. So cost to fulfill a contract are only those costs which are only progress relevant. Otherwise, other costs are not considered during revenue recognition. Third, what happens? How do you recognize revenue in case of royalties? IFRS 15 states that revenue from sales based royalty should be recognized when the subsequent sale occurs. For example, if a company has to receive a royalty income from some party, you do not recognize your revenue on cash basis. You will not recognize your revenue when you receive the royalty cash, but rather you will recognize your revenue when the sale occurs. All right, when the sale occurs, not when you will receive the cash. If for example you are Mr. A and Mr. B sells your music to customer C, and for example on 1st April the sale has been commenced, and as per the payment terms you will get your money 2 months after on 1st June. Now you won't recognize your royalty income on 1st June, not cash basis, but when the subsequent sale occurs you will recognize your revenue. Make sense? So this is plain accruals concept, nothing else. My friends, I'm very pleased to announce that we have completed IFRS 15 in totality. The basic lectures and the advanced lectures are all together complete. I hope you find them interesting. You just need to practice past papers. You need to get in coordination with me. You need to contact me. You need to discuss it with me. I'm always available on the given particulars. Please feel free to contact me. Have a good day. I wish you best of luck.